The big players and property portals continue to push their 2026 property price forecasts. You're seeing headlines everywhere calling for modest single-digit growth across the country, with some a bit more optimistic like Nationwide at 4%, while others like Zoopla are forecasting just 1.5% growth over the next 12 months. They all agree on one thing. Over the next 12 months, we should see small single-digit growth across the country. The problem is, this average figure is a lie, and if you just listen to the average forecast across the country, you could be costing yourself tens, if not of hundreds of thousands of pounds worth of growth over the next few years. While London and the South East hit an affordability ceiling, there's areas in the country that are still performing well and should have strong growth not only over the next 12 months, but also over the next 5 years and moving forward beyond that. In this video, I'm going to pull back the curtain on why the average figure throughout the UK is now fiction in the modern market. I'll show you data on which northern areas should have strong capital growth moving forward and why. And I'll show you how you can position yourself in a way that maximizes your success even with this north-south divide. If you're new here, welcome. My name's James. I'm the co-founder and managing director of a property investment consultancy called Freighter Property Partners. But this channel is all about your education, so let's jump into it. So what's so dangerous about the word average in the modern market? Well, if you have one foot in boiling water and the other in freezing water, the average temperature of these would sound pretty comfortable, but in reality, you'll be in a world of pain. The 2026 property market is exactly the same as this. You've got one side of it, which is very poor growth because of a lack of affordability and other impacts in the wider market, and another part of the market that should have pretty reasonable growth for 2026 and beyond. This is where national headlines of 2% are dangerously misleading. The South and the Southeast are unlikely to get growth anywhere near that 2%, and there's significant opportunity to get way beyond this in places in the North. First, let's look at the numbers of multiple business that produce these forecasts and work out exactly what they mean. First, Savills are projected growth of 2% nationwide, but Savills understand that the market is very much regional, and because of that, they look at specific areas and forecasts for different regions and what they might look like. The most recent forecasts that Savills have put out show that the Northwest, Northeast, Yorkshire and other regions like that are likely to have the best growth moving forward. If you couple this with Zoopla's analysis of the market, they're projecting the North and places in Scotland to have the best growth in the next 12 months. And they also suggest that the South and places like London are likely to have very minimal growth, if any, because of a number of reasons. So what's the main reason for this? It all comes down to one critical factor, and that is affordability. For years, London performed brilliantly. Between 2008 and 2016, there was really strong growth throughout the region because there is massive institutional investment and there's massive growth engines behind the City of London. Although prices had increased in this time, the market was still supercharged by rock bottom interest rates. Those days are now over. With interest rates stabilising at a higher level, affordability has dropped for lots of people throughout the country. This means that people living in these regions have hit borrowing limits and are essentially stuck when not able to move house or move properties. When you look at the average house prices in London boroughs being well over £500,000, even just a small shift in mortgage rates has quite a hefty impact on the monthly payments on your mortgage. This means that there just isn't much headroom for prices to continue to grow because of the lack of affordability, and demand drops because of that lack of affordability. If we now consider the so-called mansion tax that's meant to be coming in 2028, although this doesn't completely change the market, it still adds to the negative sentiment going on in the South and the Southeast, which puts another brake on the top end of that market. The result? Forecasters are predicting the market in the Southeast to be extremely sluggish and fall in certain areas of London and the Southeast. And this is exactly the stagnation I'm talking about. If you own a property in the Southeast and you're expecting 2% growth in the next 12 months, you could be in for quite a big disappointment. So let's look a little closer at the challenges the southern market is currently facing, because we don't just want to know what is happening in the market, we want to know why, because that is what makes an informed investor. The story in 2026 is one of low growth and low yields. Take London as an example. The gross yields right now are around 3.9%. Once you factor in things like service charge, maintenance costs and any taxes, the likelihood is you're going to be making little to no money every single month. And when you look at the entry points of properties in London in the current market, that's a lot of money to tie up to a property that barely keeps up with inflation. The South Coast and South East isn't much better, as it usually follows the London market. And Zoopla data shows a clear trend of a weaker market. Properties are staying on the market for longer, which is a clear indication of a lack of demand or a lack of affordability within that region. The fundamental problem is the high entry point of properties in this region. If you're buying a property for £450,000 or more for a standard buy-to-let in the southeast, your rent just can't keep up to provide you a healthy return. Affordability constraints are the real problem in the modern market in the southeast. All data you look at from ONS, HomeTrack, and lots of different property analysis tools will show you the same thing. This isn't just a blip in the market, this is a long-term trend. What we have is a perfect storm for stagnation. High prices means home buyers can't afford to keep buying properties, which means this caps growth. And those same high prices make it very difficult for property investors because things just don't stack up in that market. This is why businesses like Savills and other organisations are projecting way better growth in places like Yorkshire and the Northwest, because affordability is still there, and they're stating that affordability is one of the major things of what we can use to project growth and predict growth in the next 5 to 10 years. Projections expect Yorkshire to have around 27 to 28% growth over the next 5 years. The Northwest and the Northeast to have even better than this. And growth in London and the Southeast is projected to be almost half that of these better performing locations. Yes, eventually London will recover, but for the time being, where salaries are and the affordability stats show everything going to the north. Now this is where the story gets exciting for savvy and informed investors. While the south has hit an affordability ceiling, the north is just getting warmed up. It has the three things needed for any long-term capital growth. Lower entry points where the local people can still afford the average home, high yields which stack up for property investors in the modern market, and a lot of scope for further growth. This isn't just my opinion, this is backed by data. Since 2022, the data suggests more and more property investors are investing outside their local area because they're chasing better yields and more affordability for future capital growth. So let's look at the engine room for 2026 and beyond, region by region. First up is the Northeast. And this region is beyond a doubt the yield play. We're seeing average yields from 7.8% to 8% for standard buy-to-lets, and you can get better than this across the region. This is easily the easiest place to get a strong yield in the current market all across the north. Prices here are still super affordable because of a lack of capital growth over the last 10, 15 to 20 years, which means if you're just targeting yield, this is probably the place to invest. Having said that, the Northeast has struggled for long-term growth in the past, which is the reason for these super low entry points. But there is a lot of changes going on in the modern market, so if you are looking for long-term growth, the Northeast might be a place to consider, but maybe not quite yet. We might want to wait a year or two until we know for sure that certain investments are going to happen in the Northeast and there's going to be massive regeneration and transformation. It looks like this is going to happen with the big AI boom that's expected in the Northeast, but you might not have to go to this location yet because the next 2 to 3 years still might not have amazing capital growth. Next is the Northwest, which is more of a story of dynamic growth and massive institutional regeneration. Cities like Manchester and Liverpool are still booming in the current market. You've got improving infrastructure and better transport links, but alongside this, you've got massive multi-billion pound regeneration and institutional investment. Both Liverpool and Manchester are getting multi-billion pound transformations, which are making them destinations, which creates more jobs and in turn creates more demand, which means more people move to the areas and prices increase. Not only this, it's fueling rental demand. If people are moving to the area for new jobs, that could be young professionals and professionals, they're going to want to rent good quality homes, which means demand is continuing to be there in these local areas. Because of this, rental growth is really strong in this region, and we're seeing massive rental growth increases year on year, which are way faster than inflation and things like that. The Northwest's rental growth from January 25 to 26 was a whopping 6%, which completely blows London's 1.1% growth out of the water. So if you're looking for a story of massive regeneration, increasing demand and increasing rental growth, then the Northwest is one to consider. Finally, let's look at Yorkshire and Humber. This region is a fantastic blend of affordability and potential for growth. Cities like Leeds and Sheffield are attracting more and more investment, and yields across the region are consistently high because of the lower entry points than other locations across the country. Like the Northwest, transport links are improving across Yorkshire and the population is growing. Because of the affordability in the region, this means that property prices should continue to increase in the near future. When we look at analysis from Zoopla, it shows that property prices are selling at market value and selling pretty quickly, unlike places like the southeast where prices are having to be dropped and are on the market for longer and longer in the modern day. Therefore, the market is crystal clear. The data shows a decisive shift in the modern day. The combination of low entry prices, affordability, high yields and institutional investment are making these regions way more attractive for the average property investor. The north is where the opportunity is for better rental yields and capital appreciation, which is what most property investors should be targeting. If you are based in the south but you're looking for better regions to invest in terms of property moving forward, I'll put a link to our website, Freighter Property Partners, in the description, and you can have a free chat with one of the team. All day, every day, we help time-poor property investors invest in properties all throughout the best performing locations in the UK. So if you are based in the southeast or the southwest and you want to get into these better regions but you don't know them very well, we can help you. And it's not just about buying a property in these regions. You need to know the area as well. You need to make sure that you're buying in the right areas where they're getting institutional investment, so you can be confident on the long-term prospects of where you're investing in property. So let's tie this all together. The previous property investment playbook was buy in London, hold that property, see strong growth, and then refinance, scale the portfolio. In 2026, that advice would be a catastrophic mistake, whether you're based there or anywhere in the world. The national house price of 2% growth in 2026 is a bit of a smokescreen, and it could be anywhere from 0% in the southeast to 4 or 5% in places further north. The south is grappling with the legacy of its own success. As prices have hit a ceiling, properties are not going to continue to grow in value in the near future. The smart money is moving north. That could be the Midlands for some people that don't want to go so far away, because the Midlands do have strong capital growth and prospects, but a lot of people are targeting the Northwest, Yorkshire, as well as the Northeast for better yields. Demand is robust, your yields are better, and there's great prospects for long-term capital growth. Not only this, it's backed by billions of pounds worth of regeneration, so if you're looking where the big money's being spent, you can't go too far wrong. So like with all property investment, make sure you're following the data rather than just going on what I or anyone else is saying in the current market. Data doesn't care about our feelings or your ties to any specific locations. But let me know, where do you think will perform the best in terms of capital growth over the next 5 years? But thanks again for watching, and I'll see you soon.